Have you ever wondered how banks create money? This question might seem odd at first glance, but the answer is even more peculiar. It's a tale of digital wizardry and a system as old as the hills, the fractional reserve banking system. In a nutshell, banks don't really store your money, like a vault full of gold coins. Instead, they operate on the premise that not all depositors will demand their money at the same time. This allows them to lend out more money than they actually have in their coffers, creating new money in the process. Let's break it down a bit. When you deposit money in a bank, they're required to keep only a fraction of it, the reserve, on hand. The rest is free to be lent out to others. The catch: the money the bank lends isn't from its pile of deposits, it's essentially created out of thin air. Imagine you deposit £100 into your account. The bank sets aside, say, £10 as reserves and lends out the remaining £90 to someone else. That someone then deposits the £90 into their own account, and the cycle continues. At each step, the bank is creating money, not physical banknotes or coins, but digital currency. With each loan, new money is born, expanding the money supply in the economy. So when the bank gives you a loan, it doesn't reach into a vault and hand over a stack of cash. Instead, it simply adjusts some numbers in a computer system, and voila, you have your loan amount. It's money conjured from the ether, a trick as simple as it is profound. Therefore, if you were to peek behind the curtain, you'd realize that the money in your account isn't really there. It's not nestled safely in a vault, it's not stacked neatly in a teller's drawer, it's just digits on a screen, a numerical illusion. So, the money in your bank account isn't really there, it's just a number on a screen. Did you know that interest rates are not exactly what they seem? Let's dive into the fascinating world of interest rates. Interest rates are the cost of borrowing money, but did you know that they're also a tool that banks use to control the economy? Yes, you heard it right. Banks have the power to adjust interest rates. They use this power to manage inflation and stimulate economic growth. Here's how it works. When the economy is booming and inflation is on the rise, banks increase interest rates. This makes borrowing money more expensive, which can slow down spending and cool off the economy. On the flip side, when the economy is in a slump, banks can lower interest rates. This makes borrowing cheaper, encouraging spending and investment, and helping to kickstart economic growth. It's a delicate balancing act that banks perform to keep the economy stable. But there's more to it than just controlling inflation and stimulating growth. Banks also use interest rates to make a profit. When you deposit money in a bank, the bank pays you interest, but at a much lower rate than what it charges for loans. The difference between these rates is how banks make a large portion of their profit. So here's the secret. While it might seem like banks are doing us a favor by paying us interest on our deposits, they're actually making money off our money. And the power to control interest rates, that's a significant part of how they do it. This might seem a bit sneaky, but it's all part of the complex world of banking and finance. Understanding how interest rates work can help us make better financial decisions and navigate this world with more confidence. So next time you see an interest rate, remember it's not just a number. It's a powerful tool that banks use to control the economy, make a profit, and shape our financial world. Interest rates are not just numbers. They are powerful tools that banks use to control the economy. Ever wondered why banks are so eager to lend you money? Let's delve into the truth about debt. Debt is often viewed as a four-letter word, something to be avoided at all costs. But in the world of banking, debt is the golden goose, the engine that fuels their profits. When you borrow money from a bank, whether it's for a car, a house, or a credit card, you're not just borrowing the amount you need. You're also promising to pay back that amount plus interest. And that interest, well, that's pure profit for the bank. You see, banks operate on a simple principle: lend money and earn interest. The more they lend, the more interest they earn. It's a cycle that's as old as banking itself. But here's the kicker. The money they lend isn't even their own. It's the money of their depositors, people like you and me. And while they use our money to earn interest, the interest they pay us on our deposits is a mere fraction of what they earn. But there's more. When a bank gives you a loan, it's not handing over a bag of cash. It's simply making an entry in a ledger, creating money out of thin air. This is known as fractional reserve banking. The bank only needs to have a fraction of the money it lends in reserve. The rest is just numbers on a screen. It's a system that's been in place for centuries, and it's how banks create money. So next time you're tempted to take on more debt, remember this. Every dollar you borrow is a dollar plus interest that the bank earns. It's a system designed to keep you in debt because the more you owe, the more the banks earn. And that's the truth about debt. It's not just about borrowing money. It's about feeding a system that profits from your debt. It's a system that banks don't want to change because, quite simply, they're making a killing from it. Banks don't want you to be debt-free because they make money from your debt. Are you aware of all the fees you're paying to your bank? You may think you know, but the reality might surprise you. Banks are notorious for their hidden fees, and these can add up to a significant amount over time. Let's take a closer look. First, consider the account maintenance fees. These are fees that banks charge just for keeping your account open and operational. They might seem small when you look at them on a monthly basis, but add them up over a year or over several years and you'll start to see the impact. Remember, this is money you're paying for the privilege of letting the bank use your money. Then there are the overdraft fees. If you've ever accidentally spent more than what you had in your account, you've probably been hit with one of these. They can be steep, often amounting to the equivalent of very high interest rates. And while it's easy to say just don't overspend, mistakes happen, and when they do, it's often the bank that profits. Don't forget about ATM fees. Need cash in a hurry? If you use an ATM that isn't affiliated with your bank, you could be hit with a fee from both the ATM operator and your own bank. These fees can be particularly insidious because they're often not clearly disclosed at the time of the transaction. These are just a few examples. There are also fees for checks, wire transfers, and even for receiving paper statements. And while each fee might seem small on its own, together they add up to a substantial amount. You see, fees are a significant source of revenue for banks. In fact, banks make billions every year from these hidden charges. And the most concerning part? Many customers aren't even aware they're paying them. So, next time you're reviewing your bank statement, take a closer look. You might be surprised at how much you're paying in fees. And remember, every dollar you pay in fees is a dollar less that you have to save, invest, or spend on things you actually want. Banks make billions every year from fees that many customers aren't even aware of. So stay informed and let your money work for you, not for your bank. Did you know that banks are more vulnerable than you think? Yes, you heard it right. Banks, the seemingly invincible financial fortresses that we entrust with our hard-earned money, are far more susceptible to risks than they often let on. Let's start with loan defaults. Banks make their profit by lending out the money you deposit with them. But what happens when borrowers default on their loans? Banks can, and do, lose money. These defaults can range from a small business unable to repay its loan to a large corporation going bankrupt, leaving the bank with millions or even billions of dollars in unpaid loans. Then, there's the phenomenon of bank runs. This is when a large number of customers withdraw their deposits because they fear the bank might fail. It's like a domino effect. One person's panic can trigger another's, leading to a cascade of withdrawals that can drain a bank's reserves. Remember, banks don't keep all of your deposited money on hand. They lend a large portion of it out. So if everyone decided to withdraw their money at once, the bank could find itself in a very precarious position. Banks are also vulnerable to external factors, such as economic downturns, regulatory changes, and even cyber attacks. These can have significant impacts on a bank's stability and can lead to severe financial losses. At the heart of all this is the fact that banks rely heavily on the confidence of their customers. If that confidence wavers, if people start to doubt the bank's ability to safeguard their money, it can quickly escalate into a full-blown banking crisis. So what's the takeaway here? It's simple. Banks are not these unshakable institutions they often portray themselves to be. They are businesses with their own set of risks and vulnerabilities. Banks are not as stable as they want you to believe. They are vulnerable to a variety of risks and rely on the confidence of their customers to survive. So, next time you interact with your bank, remember it's not just about trusting them with your money. It's about understanding the risks they face and making informed decisions about your financial future.